Last week, Goldman Sachs partnered up with Motif to launch 5 new machine-driven products focused on the new age of innovation. The group focuses on topics like finance and reimagined human evolution. I know that's a pretty big topic. The man behind those ETFs is here. Hardeep Walia of Motif joins us right now. Hardeep, thanks for joining us. You and I have been talking about this for a long time, and I think your time may have come. You have been saying for 10 years that buying the old sectors, buying healthcare, buying retail, buying industrials, that all doesn't make that much sense if you're a growth guy and you're looking for how technology is changing the world, because technology is changing all of these industries. That's the purpose of Motif, and that's what you're trying to do with these new ETFs. Is that right?
Right. Tech is no longer a sector. It is the driver of growth across all industries. And so what we've tried to do with these set of ETFs is to be very scientific, and we've weighted these companies in the index by their thematic exposure to these ideas.
Yeah, so let's take one. Your Goldman Sachs Motif Data-Driven, GDAT. This is a sort of a mishmash of everything. AI, big data, cybersecurity, data infrastructure. How do you decide what goes in this? It's not a market cap weighted index. It just started. It's 3 days old.
That's right. We launched 3 days ago. So we start with the theme. We partnered with Goldman Sachs' research, their fundamental equities team. What are the forward-looking ideas that we have that are likely to drive disproportionate structural earnings growth? And we took those ideas, and then we unleash our algorithms. We look for interesting data sets, and we mine these algorithms, we mine these data, both structured and unstructured data, to come out with the list of relevant companies to these.
The word unleash algorithms sounds like a lot of fun, but also sounds a little ominous. Now, you made it clear earnings growth is a major factor in the weighting here?
Absolutely. So we
but
weight
what else?
thematically.
I mean, what is this mining the data? What kind of weird relationships do you find?
So all we're doing is, frankly, what humans do. We're doing it at scale. So we look through these data, look for companies, and then we weight by thematic beta. Think of companies that are doing interesting things, filing patents, writing interesting academic work, and we bring that all together, and then we write code to automate how these views get expressed.
John, I'm always looking for new ways to get indexes going besides market cap weighting, but is there any historic evidence that using, for example, patents as a factor in creating index creates alpha and outperformance?
Well, so I looked at some of your ETFs. So some of them do have actually history going back, the underlying indices. So some of them have outperformed. They're the equivalent like sector spider ETFs. Some of them have trailed, but it kind of depends. I mean, you've got some very idiosyncratic stories going on in some of them. I love the idea of using like AI data and coming up with like new ways to kind of slice up the market. I think GICS, tends to be fairly slow in terms of react, like when they, kind of update the sector composition. So very interesting. I'm definitely rooting for you.
Chris?
I mean, look, this is, we're big fans. We're big fans of this thought process about disruptive technology, disruptive investing, the names that are in these indices. And if you look at the performance of these indices year to date, I think you'll see some significant outperformance over the broad market.
So you think constructing indexes this way, including patent applications, can potentially outperform? It all sounds great. Big data, we've got algorithms unleashed on the whole thing. I just want to see the outperformance, that's all.
I think you have to put it into a risk model. You have to do like your underlying due diligence and look at a portfolio construction tool to understand, what are the unique sources of risk and return for these stocks.
Let me give you some of them. There's 5 of them that you just launched. The finance one is interesting. Digitization of finance, blockchain, asset management industry, how it's changing. You've got here MasterCard, Visa, PayPal. This sounds like these are the companies that dominate the current fintech business.
But they also include new emerging companies. One of the problems with market cap, it's like my dad's a surgeon, it's like asking him to do surgery with a machete. They don't do what they're supposed to do, and you have days like today where you get out and underperformance just by the swings of having a huge market cap bias. So what we're trying to do is really discover insight that isn't. Alpha is getting harder and harder to go out and go. And near-term alpha is even harder because you've got all these ARBs going on with hedge funds. So what we're trying to do is look for long-term ideas that have structural tailwinds behind them and find interesting way of being scientific about demonstrating. And one of the nice things about our model is we can be very prescriptive and demonstrate a company's exposure to a given theme a lot more than an equal cap or a market cap weighting can do.
And here's one of my favorites, the Motif Human Evolution ETF. I'm in favor of human evolution. Precision medicine, robotic surgery, genomics, life extension, and again, some familiar names here: Medtronic, Intuitive Surgical, AstraZeneca. Maybe we should put in the smaller names because they're the ones that have potential growth. You're putting in the biggest holdings here.
Yeah, so there are 120 companies in each of these ETFs. They span the globe. We cover 11 markets. So these things are pretty unique. Of course, you have the obvious names, but you also have Illumina and all these other smaller cap names in there. So we've intentionally been thoughtful in giving you exposure to innovation.
I love all of this talk, but I'm wondering, is this a crowded space, guys? I mean, we all know about the potential for this to grow exponentially and exponential technologies, but everybody seems to know this. He's slicing and dicing it a slightly different way. I think that's a wonderful way to do it, but is there going to be alpha generated here, given how intense the interest is?
Absolutely. I mean, look, the growth in the ETF space, the growth in this kind of investing is very steep. And we expect it to continue. We think the assets are going to pour in. 20 years ago, 5 ETFs held 90% of the assets in all of ETFs. Today, there's 300 ETFs, more than 300 actually, that make up 90% of the assets. What that's telling you is that more and more of these kind of ideas are coming to market. And as they do, and as they mature, people are putting real money into them. Not just retail investors, but institutions are putting significant dollars and significant allocations into some of these funds. And we'll definitely see that going forward.
That's a good thought.
Yeah,
Quickly.
to the point about GDNA, so you have 120 stocks in there. If you load it up into a risk model, you basically, it has slightly higher total risk relative to XLV. And a lot of that comes from you're taking advantage of the size factor because you weight, like for instance, Johnson & Johnson is 10% of XLV. It's like 3% of your ETF, and you've got 120 stocks. So I think that's a way to kind of, you're able to harvest.
Potential alpha can come in.
Yeah, and it's outperformed XLV by 14%, the underlying index. So.
Great.